Hello, welcome back to the Factum Beat the Banks podcast. I'm Wade Borth. I'm a guest host today. With me, I have David Zapata. David is in our Phoenix location. I'm in the Factum office north, and I say north, way north, up in Fargo, North Dakota. So I'm excited to be here today. And in this podcast, we really talk about savings. It's interesting because this is it's not an investment conversation. This is a savings conversation where a lot of people think this isn't sexy. But to me, it is one of the greatest conversations we can have. So what we try to teach people is it's not about the investments, but how much we're saving and the environment that we're saving our dollars in. And if we can understand those two components, then we have choices in life. And because right now the average American has very little choice in life, because what do? They don't save enough, so therefore they have to go to Wells Fargo to be able to buy things and do the things they want in their business and their life. So what we're trying to do is change that narrative. We want to say, if you as Americans, because income's not our problem, we already know that. We've talked about that a lot of times. The problem we have is how much we're saving and where we're saving at that environment. So today we're going to talk about the idea of the environment or where we're saving it. So David, a lot of times I'll talk to people, I'll talk to agents about what is life insurance. And you've heard me say this many times, but I'm going to share it with the listeners. To me, this is how I see life insurance. And really, if we think about it at its core, all life insurance, especially a whole life insurance, let's be very specific. Whole life insurance with a mutual insurance company is just a professionally managed bond and real estate portfolio done at an institutional level, right? Guaranteed never to go backwards. In a wrapper that gives us a lot of other advantages, like we get a death benefit. So we have an exit strategy already designed. If we die or we want to leave, we already know what those dollars are in either of those cases. And it also gives us some tax benefits, either for the use of your money. If you're using it properly, we don't have to pay income tax. Or if we die, it's got definite advantages there too from an income tax standpoint. So we're not having to pay income tax. And so, again, let me just say that one more time again, and I want to get your feedback on that. What is life insurance? It's a professionally managed bond and real estate portfolio, for the most part, done at an institutional level, guaranteed never to go backwards. Go.
Thank you for having me. Love being here and having conversations with you, Wade. That's a powerful idea, man. It's amazing to hear the noise on the internet through clients of the confusion, the miscategorization of what whole life insurance is and what is not.
Yeah.
For the purposes of staying aligned with all of our training, our foundations presentation, let me state what is not. Whole life insurance is not an investment, people. If you hear somebody say that, I just heard somebody from a stage leader of a big organization with a friend from Goldman Sachs say, how can whole life insurance be pitched as an investment? The moment I heard that, I was like, okay, this conversation is going to take the wrong turn. Whole life insurance is not an investment. It's a wonderful savings environment. And I love when you've brought that definition to me, Wade, because it makes me get very clear about what it is. And we should deep dive into the elements that you're mentioning here. A professionally managed portfolio. Think about that start there. How can you co-generate with a group of professionals that work at a very large scale, managing a portfolio of bonds and real estate that me as an individual likely don't even have access to? Let's be honest. I don't have the capital or the size or the reputation to access some of the real estate deals they do or the volume of treasuries or corporate bonds they have access to. So you get to co-generate with a giant in the economy. Yeah. And then on top of that, we're talking then about the fact that it's professionally managed. We're probably going to have smarter people than me determine risk, manage risk, determine a strategy that's likely long-term, right? That is going to take me away from the psychology and fear of should I sell, should I buy, blah, 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 like you see most people deal with. And then the second part that I love that you always remind me on that definition is that it's never going to roll back, which is the part that for me...
David, that's not what I say.
Oh, okay, sorry.
I say it's never going to go back. Guaranteed. Never
there you
go.
Go.
So,
thank you.
Do you ever hear that word in our conversation, guarantees?
No asset you buy, and I joke about this, there's not a gold mine, there's not a hole you can put in a Swiss mountain that will come back with a piece of paper that says guarantee. This is the only asset class you can acquire that will have a contract between two parties that guarantees a certain set of commitments in that asset class. So I love that reminder because it immediately clarifies, oh, okay, this is not an investment. This is a savings vehicle, which means that I don't tolerate the risk for loss and that I have guarantees to always have my money growing and not take any losses. That's when I clarify, this is where I need to store my money and this is where I operate from when I make financial decisions.
Yeah, it's a small word. And we actually get a lot of people are like, "What do you love whole life? Is it because of the guarantees?" And we've heard Kyle say that's absolutely the reason why we love this. Because if you think about it, what else in life is guaranteed? We have two other examples of that, but they really should say in life insurance. And we think about this, and it's a bit of a sidetrack, but it's not. But it's also got a built-in exit strategy. Mm-hmm. How many businesses do you ever get into, or how many other financial products have a built-in exit strategy? And I can guarantee you what the very least amount it is that you're going to get out in year X, whatever X might be. Now, if you die or you just decide to walk away or whatever the situation is or anything in between, there's a guaranteed exit strategy. That's the real beauty there. Is like it takes all that uncertainty out of life and gives you some certainty. And when you have that certainty, that gives you the ability to go do other things that maybe are a little less certain.
Yes.
Talk about starting a business. Talk about even from the investment stage. People that have that bit of certainty, and when I've heard this on the internet a lot, is like, oh, this is a great bond alternative, this product. Mm-hmm. We're going to talk about that a little bit, and there's some characteristics that's true. But when you have that guaranteed asset, unlike a bond portfolio, which doesn't have a guaranteed aspect to it, it does if you hold everything to maturity, but that's a whole other discussion, then you're able to go out and take maybe some additional, I don't want to call it risk, because that's not, risk doesn't necessarily equal return. But you can do other things with your money that you wouldn't normally do because you know you have an asset that is completely guaranteed and gives you the certainty that you're going to have at least that part of your portfolio.
Yeah, and this conversation in our circle has become more and more prominent. We see leaders in the industry. I know Todd Langford from Truth Concepts is talking a lot about that, how to use whole life to anchor some of the portfolio moves that people make when they're talking about investing with bonds to an asset class that is guaranteed, that offers the benefits of being a savings environment, but more importantly, that will make actually your investments perform better. Yeah. So that's a conversation he's using through his calculators, showing it with hard-cold math to demonstrate that this is a better alternative to that. This morning we were talking about Bobby Samuelson writing an article about using whole life as a fixed income strategy. And I know we'll talk about that a little more. We both admire his writing and his thinking. He's a very intellectually honest individual. But I think it's interesting that leaders are talking more and more about this because it's a way to, I think, change the narrative and look at it in a different angle that will make people think, what is this really able to do? It's not just a vehicle for protection, and it's certainly not how the common narrative goes about, oh, expensive to own, low rate of return, the worst investment in the world. That is incorrect, inaccurate, because it's misclassifying it. It's a great savings environment, and because of the nature of who's managing and how it's managed and in the asset class by this mutual insurance company, it presents a significant advantage to be incorporated in our financial life.
And it is so interesting because a lot of things that we think or we think we know is typically developed out of the environment that we're in. Mm-hmm. 2 years ago, 3 years ago, heck, 8 months ago, I heard people on the internet says, oh, it's got a greater rate of return than bonds or anything else you can get. So they're selling this idea, they were selling a short-term idea with a long-term product. Mm-hmm. That, hey, it's got a great rate of return, which it absolutely does. But compared to what is always the question, right? Yes. And again, I think we're going to talk a little bit more about Bobby Samuel. I heard him he puts this in such great context that I love kind of his writing. You have to pay for the service, and if you want to, I think it's money well spent if you're looking at this at all. It's called
the Life Product.
Life Product Review. Thank you, David. I had just a mental block there. Senior moment. But he does a great job of explaining this, and I've heard him speak from the stage in this, and it's not something we don't know, but he did a good job of putting it in context. And to where, in today's world, I can go out and I can get a CD that pays more than my life insurance policy. If what your conversation was always been around, hey, it's the highest rate of return, now that's not true. But there's other things that of value there that we have to talk about. Because there are people that are saying, I'm going to go ladder bonds or term treasuries for 3, 6, and 9 months. Think about the complexity of that, where if you had this perpetual process, this perpetual asset that does exactly that for you, then why do you want to do it? And then you don't have to worry about these other things we're going to talk about.
Just really quick, actually, that's a perfect example because it's very tangible, and I think it's funny to see recency bias in people. Right now, in a high interest rate regime, people are thinking, "Oh, I can get a lot of yield on my savings account on a CD." And the question I often bring to those people is, what were you doing in 2012, 13, 14, 15, 16, 17, 18? We had a zero interest rate policy that was driving that whole circumstance to the polar opposite. And the question is not, can I guess what's happening next? But I only know that things are going to change, and they're going to change over time, especially if we make it a long time frame. So I want to be associated with a savings vehicle that can give me that control to maintain a high savings yield rate for the rest of my life. Not only that is high today, but it continues to accelerate over time.
Yeah, with very little or no noise. Zero noise. I guess very little or no noise, but you're right, zero noise.
Yeah.
And the tax advantages that go along with it. This is the crazy part. Nelson talks about this in the book as the cost of acquisition. And again, I'm going to go back to the people that are going to buy 3-year, 6-year, 9-year, 1-year treasuries or 9-month treasuries. What's the complexity of that? How much time are you spending trying to make that happen? Or I'm going to ladder out my own bonds, or why not hire the professionals? And let's go back to what we were saying right at the beginning. Professionally managed. Let's find a professional management team that's done at institutional level. I know a couple of people that can actually do things at institutional level. You probably know 1 or 2 as well.
Mm-hmm. Yeah.
But most of us aren't doing this at an institutional level.
Yes.
With this long-term view that will guarantee us an asset that never goes backwards in price.
Yeah.
How powerful is that? And then if we can eliminate all that noise, then we can go do what we should be thriving in, which is running your business, buying real estate. Whatever it is that you find passion for, hold your dollars over here in this professionally managed bond and real estate portfolio, and you're good. And you can go do take your time, that precious thing that we have on this earth, and go strive and thrive in the thing that you have. Take all your time to do that in. It's a real key.
It's at the core of our economic model, right? Specialization. I know that if I focus on the things that I'm really good at, and I leverage everyone around me doing the same, we advance as a society much faster, right? So I'm going to co-generate with these mutual insurance companies, with the professionals that offer me that ability to transfer risk, so I can go and deliver my value, focus, and scalable in other areas. So absolutely.
Yeah, when you say transfer risk, maybe that's a good time to get into one of the things that I found really interesting about one of the latest articles from Bobby Samuelson.
Yep.
So he talks about there's other things than just interest rate risk. I think most people understand that risk in itself is just that. It's like, what's the unknown? What's the uncertainty? With buying your own treasuries or your own bonds, you take an interest rate risk. Are interest rates going to go up or down in the near future? Or in the long future? Yes, is the answer. They're going to do one or the other, stay the same. We don't know. So what does that risk mean? And in bonds, it can be a huge risk. In my previous life, when I was securities licensed, the conversation I had with clients is like, there's way more risk associated with bonds than there is stocks. Interest rates move, you could lose a ton of value of your asset, and it takes forever at 3 or 4% or 5% to get that value back that you lost 20 or 30% at. So the risk there is huge when it comes to bonds. And that's a duration risk, which means how long are we going to hold those things for? So maybe go down that list so I don't get sidetracked, David. Keep me in line. But
I'll read a couple pieces of this because I think we should share some thoughts about this. I think this article is fascinating. Like I said, Bobby is so good at being intellectually honest in looking at both sides of an argument. But on the pro side, he states, as a package, whole life insurance is makes an incredible, powerful case as a fixed income alternative with the characteristic that combine the following. So he talks about credit quality of treasuries, meaning the quality of the collateral is so high because it's backed by the government, et cetera, et cetera. The yield of corporate bonds, so higher yields when you're talking about debt issued from corporations. The tax treatment of muni bonds. You have growth that is deferred inside this whole life insurance products, and the liquidity of a money market fund, all put into one package. Yeah. I think the brilliance of recognizing that is really powerful. Imagine how difficult, how nosy it would be to balance a portfolio when you have to buy those 5 individual products to try to get some of the benefit and balance all it out, when you can just go to the insurance company and start paying your premiums and get all those benefits all at once.
Yeah, and having access to your money market type of access. Now let's think about that for just a little bit, David. Who in their right mind would put money in this type of investment? Excuse me, this type of product. It's not an investment. Life insurance is not an investment. Can I say that one more time again? Life insurance is not an investment.
There you go. You got it.
So who else would put their money in this type of financial product? Who, at a very large scale, would there be anybody wanting those key characteristics?
It shocks most people. And it's funny because it is as easy as going to FDIC.org and pulling the name of a commercial bank and going down their liabilities and trying to see what are one of the line items where they store profits and savings are life insurance contracts. Banks, the largest provider of liquidity of the entire economy. There's no bigger player than banks. Trillions of dollars hold billions of dollars in cash value life insurance policies.
Yeah. And why do they do it? What's the reason why?
Let me read it to you again. They get credit quality from treasuries, yields from corporate bonds, tax-like treatment from uni bonds, liquidity like in a money market fund. They have their money taking advantage of all those features co-generating with insurance companies, not with other banks. Keep that in mind.
Yeah, they put it with the insurance company. But what do they tell the common, average, or even above average individuals? What do they tell them to do with their dollars, their cash?
Stick with us. We are the only option you have to manage your money needs. You either can be a borrower, and we have the credit card and the mortgages and all of those things you like, or if you have accumulated some money, be a good saver, but keep it with us. We have checking accounts, savings accounts, CDs, etc. There's never the advice to say, hey, would you like to learn how we got so good at this game? Let me show you what we're actually doing with our profits.
Yeah. Yeah. Okay. I think we can just stop the podcast right here. But if we want to be honest, let's finish out Bobby's conversation. And one of the things I've shared this with my clients since probably for the last 20 years, is that and I asked this question honestly, I said, are you a short-term thinker or are you a long-term thinker? Because the one thing you have to understand is that banks and corporations are perpetual. They understand infinite thinking. They're playing the long game.
Yeah.
You and I are not, we're not here, we're not infinite. We are in our soul and our mind and our beliefs, but our body's going to be here on this earth for a certain amount of time and we have to graduate.
Yeah. Yeah.
Where I think people get really confused is that they try to find a long-term solution with a short-term idea.
Yeah.
And that rarely ever works out well. I heard this said somebody told me this one time, it's like, everybody wants a long-term solution, but they want it done over a weekend. The idea is that if we're thinking long-term, if we have a long-term objective, and this is, at Factum, this is our core belief, right? Long-term thinking, infinite thinking. And so when we apply that idea of being a long-term thinker, our process change and what we want for results will typically change as well. And maybe read a little bit about what Bobby has to say about that on the last part of that article.
And Bobby, if you're listening, I'm paraphrasing, so I'm not saying things exactly how you're written here. I'm not as eloquent, but the message is that, and it's funny you start there because that's what he says. When he then goes to the opposite side of the equation to be honest about what he's seeing, is that it's beautiful, but it's not perfect. There's some opaque elements to the whole life insurance product, and there's some trade-offs. The first one he points out, which is what you were saying, Wade, it requires a long-term horizon. So if you're trying to find a solution for the next 36 hours for your money problems, this is probably not going to be the conversation you want to have, right? Yeah. But the reality is that when we start to think about the two things that are truth, you're going to need money today and forever, and you're going to die, and you put it in that time horizon, this becomes a very aligned thing. So as he lists this as a negative, perhaps, for some people, I see it as a strength. I see it as a way to temper my thinking and get in the right plane of mind.
Yep, exactly. Because where we take it from there is like the last feature that he talked about. And again, we're talking a lot about Bobby's articles. So just people that don't know him. In our industry, he is just an independent thinker that writes. He develops products. He helps companies develop products, but he brings a perspective of an actuary to this. So he's not passionate one way or the other. He's just passionate about the truth.
Yes.
And again, Bobby Samuelson, you can go out and do your own research. Life Product Review is his paid site where you can pay to get in and get some great articles, great insight. I reference it. I love reading it. But the point being is that this long-term objective is just that. I had a client say this to me once. What's the negative, or what's the takeaway, or what's the what's the counter thought, or what do I have to give up to make that happen?
Yeah.
And the point I always make is that it takes two things that you have to give up. You have to commit to. You have to commit to it for long term because, again, I see this as perpetual. For myself, myself and my wife, our son, and any future grandchildren, anybody else that's going to be part of our family banking system. And then we incorporate this idea of banking to that last point that he makes is that we have money market access to our dollars.
Yes.
Money market type of access to our dollars. That's why it's so valuable in that banking function. And that's the other thing it takes, quite frankly, to make this successful, because this is what I tell people. I said, you have to have discipline to make it happen. Mm-hmm. Wells Fargo doesn't get $20 billion of cash value life insurance and then not be disciplined about how they use it. If they use it, they make sure they make money with it. And they make lots of money with it. That's the goofy part that people don't understand. They take $1 and they turn it into $5 or $10 or $20 or $50. This is how Wells Fargo makes money. They understand how money flows. And so our job at Factum is to help you understand how much you save, the environment you save it in, and then how we put it to work and how do we have to respect our dollars.
Yeah. And this leads to the second thing that he lists here as another thought to keep in mind, which is the internal workings of the insurance company. I think this is a very honest thought here. So he says, there's little accountability for expenses management that will directly impact the long-term performance of the policy. Ultimately, the performance of the product is contingent on the company, and as an outsider, we don't have control of the culture of the firm. And I think this is an argument that is very valid. I can see this as one of the things that people will talk about, and it is why we need to have thoughtful conversations about who we work with in the set of mutual insurance companies available to do the process that we talk about. This makes the argument for me, for example, in our partnership, and we can be open about this, we work intentionally with One America because there is an alignment in values, in culture. We know the leaders themselves own the products that they share with the consumer. There's an alignment there in thinking long term. They're more concerned about paying death benefits for my grandchildren than a quarterly performance of returns, right? Yeah. Those things align with my philosophy that in the long term, they're going to be conservative and they're going to hire people that are going to be conservative in the future to keep the tradition, to make sure that expenses and management is aligned with those values. So to me, that becomes a conversation that even narrows down the field more to make sure that you're in the right relationships and doing this in the right environments.
Yeah, that's such a key point. Is a lot of people say, why this particular company? Why One America? And I'll say, what I looked at when I seen was their intent was never to be the lead horse in the race. So let me back up one step. The universe of well-run mutual insurance companies is really small. So we're picking one company out of that really small group of mutual insurance companies. At the end of the day, all these mutual insurance companies you're going to be much better served than any other stock company. And here's the reason why. It goes back to a little bit of what he's saying there. Because I hear this, people talking on stage, the Goldman Sachs people, these insurance companies that are here just to stick it to you, is basically paraphrasing what they said. Mm-hmm. They're going to hit you with fees and expenses, and they're going to take advantage of you. But if a mutual insurance company has excessive profits, where do those profits go, David?
And that's a point that he makes in the article, but it's a participating product, meaning you're in a position of ownership, and as a policy holder, you participate in the profits of the company.
So where's the incentive to stick it to the client? It's not there.
Again, misclassification, miscategorization, and they're probably subconsciously talking about their own misbehaving. Let's be honest.
You mean Goldman Sachs misbehaves? Yeah, let's leave that for a different podcast. Let's talk about that. But the point is, you're part of a mutual insurance company, ran for the benefit of the policyholders. Any profits they derive come back to the policyholders. So their incentive to, quote unquote, stick it to you is just not there, because who's keeping that besides the policyholders? Now, our relationship with One America was forged out of some really difficult decisions and really difficult times when interest rates are zero. Insurance companies were like, man, we have to stay solvent. So they didn't want to be the lead horse. They didn't want to have the highest dividend. And everybody's like, why don't you want the highest dividend? Because the question is, what are they doing to get there?
Mm-hmm.
Are they taking chances they shouldn't be taking? I can tell you from being around in 2008 and having policies and looking at illustrations and selling different companies' products in 2008, that a lot of companies that were illustrating great then took some huge hits because they were taking really risks that they shouldn't have been taking. What we found with One America is that it was the only company that I could find that had zero non-performing bonds and zero non-performing assets in 09, 10, and 11.
Yeah, that was one of the favorite things that I've heard this year. Scott Davidson, CEO of One America, was kind enough to visit us in our office in Phoenix earlier this year. And one of the conversations we were having, a question we had is like, what happened in the financial crisis? And to find out that the company not only conservatively was positioned conservatively to weather the storm with the mortgage-backed securities and everything was happening in the economy, but not only they didn't lose a lot of money, they were the company that lost the least amount of money, not just life insurance, but insurance as a sector in the entire economy. Yeah. That only happens when you have the foresight and the culture to see what's coming, to have a conservative position, and to be thinking long-term about the benefit of your policyholders. Yeah. So for me, it is a no-brainer that I don't want to be with a company that's the leading horse over-promising. I want to be with the company in the business of having a long-term relationship with my family and the future of my family for a long time.
Yeah. Because quite honestly, if I'm in real estate or if I'm running a business or whatever I'm doing, that's where I'm taking my risk. I don't need my risk inside of my life insurance product. That's not the only issue, but that's a big issue we have with this thing called Index Universal Life. Yeah. It transfers risk back to the policyholder. In all reality, that's what insurance is supposed to do, is transfer risk away from the policyholder to the insurance company, because they can manage these things at a professional level, at an institutional level that's with professionals, and then give you the guarantee never to go backwards. Not another product out there that I'm aware of that can give you that guarantee.
Yeah, and Bobby makes an interesting comment here when he's talking about participating nature of whole life. And he says the benefits for universal life are discretionary. They're not embedded in the design of the ownership position of a whole life insurance policy with a mutual company. But for whole life, they're structural, meaning, like you said, if the company performs a surplus, those dividends will go back to the policyholders because it's embedded in how the product is packaged. So I want my benefits to be part of the structure set from day one to live forever within the policy and not hold the risk, but transfer it that the policy may or may not be there when I die.
Yeah. And that gives you the certainty to go do other things that maybe you wouldn't normally do.
Absolutely. I want to read you this last comment because I think this will be a great way to wrap this up, and it goes along with what we were talking about. He says, buying whole life is about understanding the product and making the leap of faith that the company will prove to be a good steward for generations to come. Good agents help clients make the leap. And I think that's at the core of the conversation we had today, Wade, is our focus really is on helping people unfold their potential. And their relationship with money happens to be critical for that because it will fund abundance in every other part of their life. And having a solid foundation to understand how much you save, where are you saving, and how to focus on cash flow producing assets, the way you deploy those dollars to create more abundance, is at the core of reducing all that conversation to simple principles. We believe that whole life is the best environment for this. We are very intentional to choose the companies that provide that culture, the mindset to do this over a long period of time on a conservative basis. So I think if people that hear this align with that mentality, they should seriously consider going through our education resources, getting in a conversation with one of our community members or agents, really exploring if this idea is for you. It may not be for you, but don't deny yourself the opportunity to discover a new idea, a new way of thinking about money, creating a new relationship that may be the next way to unlock potential in your life.
Yeah. Well, thank you, David. I appreciate that. So if you want to go out and explore, is this right for me? Does this make sense for me? I hear what you're saying. Go to factumfinancial.com. Take a look. Watch our educational videos. There's a lot of great resources there that nobody else is putting out at the level that we're putting out. The story we have is how much you're saving and then where you're saving it. And then once you've done that from a foundational level, then it gives that permission slip to go take advantage of all those other things that we're going to talk about. If it's running your business or financing your business or financing some investment, but having that foundation in place is the key. Because if you don't have that foundation in place and you try to do everything above that, it's like a house that's, go back to the Bible, if you build it on sand, it's just going to topple over. We're trying to build that solid foundation. So once you have that, then you can go make decisions that are informed decisions, and it's not speculation.
Absolutely.
So, thank you so much, David. I appreciate your time and your insight on this. Thank you to Bobby for writing such a tremendous article. I would encourage people to go out to our website, factumfinancial.com. We got a ton of resources there. And then take a look and see if this is something that you say, I want to find a better way to hold dollars, to save dollars, and then find an environment that gives me all kinds of benefits. And then at that time, we can say, okay, now we can take a look and say, how do we take control of the banking function? Because we have that foundation built for us. Thank you so much.
Thank you, Wade.
All right, talk to you soon.